When people think about buying an investment property, most of the attention goes to the property itself, the suburb, the growth potential, the numbers. But in practice, the finance side is where deals either come together smoothly or quietly fall apart. I've seen strong opportunities missed because the finances weren't set up properly. I've also seen people buy good properties but struggle to hold on to them because their finances weren't structured correctly from the start. In practice, finance is one of the biggest differentiators between investors who keep moving forward and those who get stuck. If we haven't met before, I'm Karl. I help people build long-term strategic property investment portfolios across residential and commercial real estate all around Australia. Now, just quickly before we go any further, I've put together a free copy of the slides I'm covering in this video. You can download them using the link in the description below. Now, when we talk about finance or property investing, this is where a lot of people get tripped up. Most investors don't lose deals because they can't borrow at all. They lose deals because they don't understand how lenders look at them, how loan structures affect the strategy, or how small decisions early on can limit options later. So let's break this down properly. The first step in any purchase is pre-approval. And this is where there's a lot of confusion. Pre-approval isn't a guarantee. It's a lender saying, based on what we can see right now, we'd probably lend you this amount. It's still subject to the property, the valuation, and the final checks. But it's still critical because it tells you roughly how much you can borrow and what deposit you'll need, and whether your strategy is realistic before you start making offers. From a deposit point of view, most residential investors are working around 80 to 90% loan to value, depending on the lender and the property. Commercial is very different. Lenders are usually more conservative, often 60 to 70% LVR, sometimes even lower. The important thing is to understand is that a higher leverage usually means higher rates, tighter lending, and less flexibility later. Lower leverage generally gives you better pricing and more options. It's not about borrowing the maximum. It's about choosing the right level of risk for your strategy. Once you know where you stand, the next big decision is the loan structure. This is where most people just accept whatever the bank suggests, without thinking about how it fits their long-term plan. Variable versus fixed is the first choice. Variable loans give you flexibility, offset accounts, extra repayments, and easier refinancing. Fixed loans give you certainty, but they usually come with restrictions, break costs, and less room to move if your situation changes. Then there's interest-only versus principal and interest. Interest-only loans are common for investors because they help with cash flow, especially in the early years. Principal and interest loans reduce debt faster, but increase monthly commitments, which can limit borrowing capacity for future purchases. There's no universally right answer. The best structure depends on income, tax position, risk tolerance, and where you are in your investment journey. The key is understanding that loan structure is part of strategy, not just a tick-the-box decision. This is also where investors can accidentally limit themselves without realizing it. One common example is fixing the loan too early or for too long. Fixed rates can look attractive in the moment, but they often remove flexibility. Things like refinancing, accessing equity, or restructuring later without break costs. That might not matter for your first purchase, but it can matter a lot once you're trying to buy again. Another big one is how loans are secured. Sometimes banks will push for properties to be tied together under one structure because it's easier for them. For investors, that can make it harder to sell, refinance, or move lenders later without everything being reassessed at once. It's not about avoiding the bank. It's about keeping control and optionality as your portfolio grows. That's why I keep coming back to the idea that loans aren't just a finance decision. They're a strategic decision. The structure you choose today affects what you can do in 2, 5, or 10 years' time. Getting this right early doesn't just save money, it keeps future doors open. Borrowing capacity is the next piece, and this is where many people are surprised. Lenders don't just look at how much you earn, they look at how stable that income is, how long you've earned it, and what debts you already have. Credit scores matter. Existing loans matter. Even unused credit card limits matter. Rental income doesn't often work the way people expect. Even if a property is fully rented, the bank won't count all of that rent when assessing your borrowing power. Most lenders only use around 70 to 80%. They do this to allow for vacancies, fees, and repairs. So a property that looks cash flow positive in real life can still reduce your borrowing capacity on paper, especially once interest rate buffers are applied. This is why people feel they can comfortably afford a loan, but the bank won't approve it. The lender isn't assessing today, they're assessing the risk over time. For experienced investors, this becomes even more important because every additional property reduces borrowing capacity unless loans are structured carefully from the beginning. This is where a good mortgage broker becomes incredibly valuable. A broker isn't just there to find a cheap rate. A good broker understands lender policies, how different banks assess income and debt, and how to structure loans so you're not boxing yourself in later. Some lenders are great for first purchases, but terrible once you have multiple properties. Others are strong for commercial deals, but conservative on residential. The order you use lenders in can matter more than people realize. Commercial finance takes this even further. Commercial loans are less standardized, terms are shorter, assessments focus heavily on income and lease quality, and an exit strategy matters a lot more. This isn't an area where guessing or copying someone else's structure usually ends well. One thing that rarely gets enough attention is buffers. A buffer isn't about pessimism, it's about protection. Rates move, tenants leave, repairs happen. Commercial properties can sit vacant longer than expected. Having accessible cash in an offset, redraw, or savings account is what keeps a good investment from becoming a stressful one. I generally like investors to be comfortable with at least 6 months of repayments available, more for higher risk assets. Here's the big picture takeaway. Finance isn't just about getting approved, it's about flexibility. The right loan structure gives you options later on to refinance, to buy again, or to pivot into commercial. It also allows you to ride out market changes. The wrong structure quietly limits you without you realizing it. And if you're at that point where you're actively looking to buy, this is where getting the finance side right can make a real difference. Loans don't sit in isolation. They work best when they align with your broader strategy, your risk profile, and what you want to do next as an investor. If you'd like support navigating this properly as part of an end-to-end buying strategy, I can help. You can book a free consultation with me via the link in the description below, and we'll use that time to talk through your situation to see how I may be able to help. And once you've got your finance sorted, the next piece of the puzzle is making sure you buy the right asset and manage risk properly. I'd recommend watching my video on property due diligence next, because finance and due diligence go hand in hand. You'll see that video linked on screen now. Thanks for watching. I'm Karl, and I'll see you on the next one.